Good afternoon, everyone. Welcome to the Big Review, the flagship event of HDFC Securities, where we talk about the market announcement outlook for the financial year of 2026-27. I'm Mannat Kaur, your host for the afternoon, and it's a pleasure to kick off what promises to be an insightful session on India's economic landscape and investment opportunities. Before we dive in, I'd like to thank the media partners present in the room. It is because of you that we are able to spread the expert perspective to the wider audience. Thank you all for joining us today. Today, we shall be hearing from a powerhouse lineup of HDFC Securities who will share their sharp views on macro trends, sectoral picks, equity strategies, and retail insights. Let's get started without any further delays. Starting us off is the visionary at the helm of HDFC Securities. Please join me in welcoming Mr. Dhiraj Relli, MD and CEO at HDFC Securities, for an opening address.
Hello, good afternoon, everyone. I was expecting a more resounding good afternoon because markets are up 3.7%. Thank you so much for joining us this afternoon. Happened to be a good day. Normally we do this colloquium or a annual event somewhere in the third week of December so that we can give you a market outlook for the next calendar year and talk about our preferences on the sectors and stocks and so on. This year when we were in December, we thought let's do this event in somewhere in March because markets have been going through a down cycle for quite some time, and let's get a better perspective on the earning growth for the next fiscal, and let's do this event in the March. When we were in March, this West Asia war happened, and then we thought let's wait. Maybe in a week or two or 3 or 4 weeks, the war will be over. But as we are in the now beginning of April, war is still going on. We got some relief in terms of a 2 weeks of ceasefire. Hope that this is a permanent relief and not a temporary relief. Let's the some greater sense prevail and we get a better outlook after 2 weeks, and there's some agreement whereby this war ends. But having said that, in the current environment, we've seen a full-blown VUCA event playing out. We've seen unprecedented volatility, uncertainty, complexity, ambiguity playing out. We've all seen how the markets all over the world have responded, reacted to the Trump tantrums, and we've seen this kind of a volatility, and this volatility is continuing only. If we look at the global environment, I think my take is that the volatility or uncertainty will still continue for some more time. Definitely oil is not well, so which means that it is having its own cascading impact on the inflation, interest rates, earnings of most of the companies, and it has impacted almost all 8 billion people on the earth. And the higher crude cost will have its own impact in everyone's life. Let's hope for the best that we'll see soon some relief in terms of West Asia war. And if we get to see the war ending soon and some improvement on the supply chain side and also oil prices coming down, I think then the public memory will be short-lived. We'll forget the war. We'll start talking in India more so about the IPL and probably going forward monsoon and move on to the festivities of Ganesh festival and Diwali and so on. But at global level, I think we will continue to see the volatility on the commodities side. We'll continue to see volatility in the equities. We'll continue to see the volatility in the crude oil prices. So of course it will have its own impact, but if it is short-lived, then we see that normalcy will come back faster than everyone is expecting at a global level also. Coming back to the India, I think the macro environment is still pretty much solid, rock solid and stable. We've seen the RBI policy today morning, and RBI has only moderated the growth outlook for GDP with the moderate amount only. We'll grow at 6.9%. Many other agencies have also tapered the GDP growth by 30 to 40 basis point, but nothing beyond that. And also, we have seen that in India, the earning that we were expecting to grow in FY27 at about 14-15% high teens, now maybe taper off to about 10 to 12%. If war continues for some more time and we continue to have a negative impact of the crude oil prices in India sustaining for over 100 on an average basis for FY20, then probably we'll go to a single digit earning growth. But my take and our take is that we should be in double digit only, maybe lower double digits, 10 to 12% kind of an earning growth. The other thing is that the earning growth quality will be very different this year in FY27 versus FY26. It will be far more broad-based, and we'll see many more sectors and many more companies participating in the earning growth. Of course, it will have an impact of the lower base also. And also, we have seen in last 18-20 months both price as well as time correction. What's looking good in India, where we see more optimism, is that risk reward is favorable. Why we were having relentless selling from the foreign portfolio investors? Because we had a froth in the valuation, more so in the mid cap and small cap, but even in the large caps as well. In last 18 months, we've seen price and time correction, and this has led to a significant, now risk reward is significantly favorable. We are close to 18 times of the earning. I think that's something lower than the long-term averages also. And even in the war-like situations, we've seen the worst come worst scenario is about 15 kind of price to earning multiples, which means clearly that even if there is a sustained West Asia war and it's having its own negative impact for longer term, then the downside risk is just about 5%, whereas we still have a upside of 10 to 15% for sure. So to that extent, risk rewards are favorable, valuations are looking more reasonable, more so in the large caps and also in the small and mid cap also, but there is still some spaces where we still have a higher valuation and we still have our own discomfort on the valuation in some of the mid caps and small caps. But having said that, you know, the risk reward becoming favorable is posing a great opportunity of bottom up stock picking. Last 18 months also have been a more or so stock pickers market only, but going forward it will continue to remain as stock pickers market only. My take is that, you know, last 18 months we were finding hard to pick up the stocks that can do well, give higher than double digit kind of returns. But now when we are looking at the universe, we have over 270 stocks under coverage in the institutional equities, and then we have a wider coverage in the retail prime research. We see now we have significant opportunities to come out with the recommendations where we see good upside potential because the valuations are reasonable and the earning growth visibility is good. So macro environment, barring the outlook on the monsoon, looks reasonable to us, favorable to us. Monsoon is one area which we can't, as one variable which we can't ignore. And yesterday we got some outlook from the SkyMet that it will be 94% of the long-term averages and plus minus variable of 5%. Now that plus minus variable of 5% on a 94% is something a bit more disturbing, because if it is closer to the minus 5%, 90% or 89% of the long-term averages would create its own negative impact on almost various sectors, as well as also sentiment-wise it would be very negative. So that's one variable we need to watch. We need to wait and watch for the IMD outlook on the monsoon side. Hope that will be better. And if we get 95% plus kind of a long-term averages monsoon and wider precipitation, then we are fine with it. Other than that, I think most of the macro factors are looking absolutely rock solid, favorable. India remains to be one of the largest economy that will continue to grow at 7% plus minus. So that's something on a real GDP side. And if we take 4.7% of inflation, then nominal GDP of 10-11%. I think 10-11% of nominal GDP is something very, very good, and we see great potential in India going forward. FY27 looks to be a great year. Through this colloquium or this event, the big review, what we are looking forward to share with you are an outlook on the markets, a detailed outlook on the macro environment, both global as well as Indian macro environment. And also we will give you our perspective on the sector level. We'll also talk about the retail investors' behavior. We'll also cover some of the stocks where we see a significant opportunity. We've called that as a bounce back basket, and that's something we'll share with you. So next 1.5 hours time, we would want your undivided attention. I'm sure this would be a great opportunity for you to get a wider perspective on way forward. Varun will take largest time in terms of covering the outlook on the market side. Then Unmesh will come. He'll talk about how the domestic institutions will behave, what kind of cash they are sitting on, and he'll also talk about the foreign portfolio investors and when they will be back in India. And then Devarsh, who's our head of prime research, will talk about the retail investor behavior, and also will give you bounce back stock. So we have a power packed 1.5 hour lined up for you. Look forward to have interaction with you after that. Thank you very much. Thank you.
Thank you so much, sir, for those insights. It definitely sets a strong foundation for what's in discussion today. To further deep dive into the macro level analysis, I'd like to invite Mr. Varun Lohchab, the Chief Research Officer, Equities at HDFC Securities. Sir, the floor is yours.
Yeah, hi, good afternoon, everyone. Thanks, Dhiraj, for setting the context. So what I'll do is I'll just quickly touch upon and go into details of points which Dhiraj talked about in terms of how the macro is shaping up, how the earnings are shaping up, and which sectors are our preferred bets. Yeah. So in terms of overall macro, despite the war, we believe FY27 is not looking too bad. In fact, on most factors, it's getting better. So if you look at the top left chart, both nominal GDP and real GDP will remain in that 6.5 to 7% sort of a range. We expect a GDP growth hit of only around 40 to 50 bips due to the ongoing sort of geopolitical issues. And nominal growth will still look much better because of the improvement in inflation. And the good part is, the starting point of inflation, as you can see in the bottom left chart, CPI and WPI, because we were close to zero, we would only go to around 5% levels, even if crude were to remain at, 9,500 levels for the next 3 to 6 months. So I think compared to some of the previous cycles, India has seen $100 crude multiple times in the last 15 years. And in fact, the inflation levels in those times used to be much higher at around, 7 to 8%. This time around, government has some cushion in terms of, the retail prices never got the full benefit when crude went from 90 to 60. And therefore, we believe on the upside also with crude going from, 60 back to 100, we'll not see the full sort of pass through of higher crude prices through retail prices. So and even the fiscal maths doesn't look too bad. There are enough there are some cushions in the government, this thing in form of RBI dividends and even possibly a windfall tax on the on the oil producers the way we had last time, which will kind of make sure that fiscal deficit also will not kind of worsen significantly. So I think most of the macros are still looking decent. Currency, obviously that has been the biggest macro sort of a headwind and possibly the only factor which has been negative. And in fact, out there, frankly, it's like whatever could have gone negative has gone negative in the last, 2 to 3 years. If you look at net FDI, while gross FDI is still stable, because of, primary markets being very buoyant in the last 2 years, a lot of IPOs and all led to, FPI, on a net basis not being, the FDI not being a positive number, which you can see in the top left chart. But we expect, with a slightly more modest sort of a market conditions, the primary activity will slow down and gross FDI will remain, healthy. So I think FY27 will be a better year from a net FDI perspective. FIIs continue to be negative, but again, if you see, we have seen 2 big, large negative FII flow years. Historically, we have never had 3 consecutive big negative, sort of FII flow years. So, our view is, and we'll be, kind of talking about that in detail, but our view is that while India still is lacking some of the triggers for a big, comeback of FPIs, but at the same time, we believe that it's going to get better in FY27 compared to FY25 and 26. So there are, I'll show in the subsequent charts. And if you look at currency, the bottom right chart, while we tend to get, we tend to focus on the short term and, the headlines everywhere that rupee has been the worst performing currency in last few years, which is true. But if you see, it typically goes through its own cycles. 2010 to 2013 was a similar cycle when rupee depreciated quite significantly in those, 3-4 years against most of the major currencies. Then came a good stable period of 5 to 6 years where, the depreciation was far more measured. And again, last 2-3 years, because of the confluence of these 2-3 things coming together, we have had a weak sort of a period. But we believe we are at the fag end of this, of the sharp currency depreciation sort of a cycle. So even that would possibly come as a, as a tailwind for when FPI is looking to invest in India, that, possibly the worst on currency is behind us. Earning growth, as Dhiraj said, after a weak FY25 and 26, where we had an aggregate earning growth of only 2% and 11% for our coverage universe, and which was primarily the reason why we were cautious in the last 12 to 18 months, because it was a combination of very high valuations and low earnings. FY27, estimates, this is, pre-war, so not, but they were at 18%. If you see, they were very broad based. So earning growth was coming from multiple sectors in FY27, and, even FY28 was looking healthy. If, this 18% looks high, but this is for the entire coverage universe, which includes mid and small caps, and mid and small cap earning growth was expected to be higher and is still expected to be higher than Nifty. The same number for Nifty is, was around 13% pre, this geopolitical conflict. And our estimates, we have done some sensitivities that even if crude were to remain at, $100 kind of level throughout FY27, the earnings hit is going to be around, 5 to 6% at best, which means, your broader markets will still do a 10% plus kind of earning growth. This 18% number will possibly come down to 10 to 12% kind of a range. And if crude were to go back to, 80, then we could actually get quite close to this number in terms of 14-15%. So I think in a nutshell, the point is, even with the war and crude sustaining at, $90 to $100 levels, our earning growth for FY27 will be better than FY26. Coming to valuations, this was again an area which we were not too comfortable with till 12-18 months back. If you see, the left side chart, the green one is the mid cap index, which has corrected from almost 40 times forward P to close to 20, 27, 28 times. Nifty is down to almost 2015-16 sort of levels. So that's very comfortable at around 17.5, 18 times, on 17.5 times on forward earnings. And small cap has also, corrected quite sharply from almost 27 times to 20, 21 times. And if you look at more than the index falls, I think the median correction has been quite brutal, across mid and small caps. And small cap 100 index, the median stock correction is almost 40%. So while index has only fallen 23% from its highs in 2024, the median stock correction is 40%. And it comes back to the point which Dhiraj was saying, that 12, 18 months back, we were struggling to find 20, 30 good ideas out of our coverage of 270 stocks, given how the combination of earnings and valuation was looking. Today, I can say that we are able to find at least 100 plus sort of stocks which are looking good from a 12 to 18 month perspective from our coverage universe. So there has been a good correction which is providing good entry points now. But it will remain a bottom-up market because aggregate valuations are still high, which means that there are still some stocks and sectors which are quite rich in valuations, because the near-term growth has been good. But once the growth in those sectors sort of goes away, there is a potential for some sort of devaluation in those sectors as well. This is just to show you what has been the Nifty's sort of lowest P in all the market troughs we had in the last 12, 13 years. So, and we have looked at trailing P because forward estimates are always all over the place in times of crisis, be it your COVID or be it your demonetization. So forward estimates tend to get haywire. So just looking at what the past earnings were and looking at what the P is, you can see that we are more or less in the range where we tend to bottom out. In 2013, it was around 15% lower, but barring that, after that, typically we have bottomed out in this range of 16 to 17 times, and today we are 18 times on trailing. Therefore we believe that possibly another 5-7% kind of a downside is possible in case the things go really bad on the geopolitical side, but risk reward has clearly turned favorable. Yeah, and just in terms of giving you some of the context, people have been doubting that whether India India is not doing well compared to other countries, and is India story really over? I think the point to look at here is to just look at the longer term context. The top left chart shows how Nifty has done in dollar terms versus all the other indices in dollar terms over last 20-25 years, and if you will see that it has been a consistent rank outperformer. And it's just that after a period of very huge outperformance, it's taking a breather and some of the other markets are catching up. So if you see the green chart, which is KOSPI, which is Korea, Taiwan, Brazil, they are all catching up, and therefore the relative premium of India is narrowing down, and we believe it's a healthy sort of a correction in terms of PE premium, because India was sitting on a huge outperformance compared to others, and was getting into a bubble kind of a valuation zone. So it's good that other markets are catching up, and India's relative premium is coming down. And I think the other point to look at is more the sectoral sort of trend. So it's not that something is horribly wrong with India. It's the same set of sectors which are underperforming globally. Be it the traditional IT services, be it consumer. These are the sectors which are underperforming globally. And if you look at the sectors which are outperforming globally, is AI. Unfortunately, India doesn't have much of that. Industrials and energy. And the share in Indian indices of industrials and energy is low, and therefore as a country it tends to underperform, and countries like Brazil, Russia and all tend to do better in times when commodities and the hard asset sectors are doing better. So I think it's more of a global theme, and the fact that some of the other markets after a huge underperformance are now kind of doing a catch up, and therefore this whole readjustment might continue from next for few more quarters, and therefore we don't anticipate an immediate reversal of FII flows, but at the same time you have to keep the longer term picture in context that as the other markets play a catch up, India, probably money will rotate back into Indian markets. Just a small slide on commodities just to show you how they are doing. The top left chart is basically, at the top is the precious metals, and this is just to show you how much precious metals have outperformed all other commodities, be it the energy basket, the industrial metals, or the agricultural commodities. So all other commodities and even energy index after crude moving to $100, and that's why I'm saying $100 looks alarming because it went up from 60, but crude was at $100 in 2012 as well. So it's had 12 or 13 years of frankly no return. So most other commodities have been in that range bound from 2012-13 to 2026. Precious metals are the only ones which have had a huge sort of a hockey stick sort of a return, and we believe precious metals are looking slightly stretched to us, frankly, and other commodities, we believe metals, energy, they will continue to be at least resilient if obviously the geopolitical concerns tend to kind of make them more volatile and increase sharply in times of uncertainty, but given the supply bottlenecks and all. But even otherwise, we believe the other commodities will possibly remain at least flat, if not sort of a vertical rise. The chances of commodities cooling off significantly is fairly low in our view. If you look at gold to Brent, obviously it had gone one-sided with gold to Brent ratio at all-time sort of highs, and from there gold has corrected and crude has gone up, so that seems to be normalizing. Versus gold and Nifty, clearly looking at historical sort of ratios, it seems that equities are more attractive than gold now in India. And between gold and silver, gold is now looking cheaper than silver on a relative valuation basis, looking at the historical sort of. This is just to give you context, in terms of the longer term sort of patterns in the various commodities. FPI flows, as I said, it's an interesting chart to show, typically how FIIs tend to behave. So if you look at the left side chart, it's a long dated, last 20-year chart. If you see FIIs, the black bar is basically FII flows into Indian market as a percentage of market cap, because absolute numbers don't make sense. Today market cap is 6x of what it was, 15 years back. So we had a huge FPI inflows from FY04 to FY14, and if you see, part of the reason was that the starting point of valuation, which was the green sort of a line chart, market cap to GDP was sub 100%, and earning growth, which is the bar, used to be in mid-20s. So we had high earning growth, low valuations, and therefore FPIs poured in money big time over those 10 years. Then came the period of FY15 to 19 when earning growth slowed down considerably for India, and we were growing in single digits at around 7 to 8% CAGR. And market cap to GDP stayed in that zone, of 90 to 100%, and FPIs, money sort of dried up. They were neither pulling out money nor putting in money because the growth was not attractive enough. Then post-COVID came the period when earning growth got a step up. So we have been growing at 16-17% CAGR post that. But the valuation re-rating, the market cap to GDP went from 70-80% to all the way to 130%, and which basically made FPIs sell aggressively in the last 4 years out of last 5 they have sold. And this chart is now coming down, and possibly in another year's time, if India doesn't get huge FPI inflows, then this chart will look lower with market cap to GDP sort of coming down a bit more. And then if earning growth tends to come back, then we'll see some FPI flows. I think the other reason why near term we believe possibly earning growth will not, like FPIs will not come back in a hurry near term is that, if you look at, this is earning growth of various markets, and India is there as well. So if you see in CY23, India had the highest earning growth among all the other countries, and if you look at CY26, actually we are the lowest earning growth. Though our earning growth has not changed so much, it's the other markets like Korea is seeing 100% plus earning growth right now because of the AI play. Similarly, Taiwan. So, but if you see CY27 next year, it's expected that the earning growth of those countries will come off, which means that at some point in 2026, FPIs will start looking at CY27 earnings and start pulling out money from there and maybe moving back to India. India will move back to middle of the pack kind of earning growth, in CY27. So I think near term things are a bit against us from a FPI flows perspective, but possibly I think we have seen a large part of selling last 10 years now. FPI net inflow into Indian market is zero. So there is an extent to which they will pull out money because most of the hot money has already gone. What is left is basically the long-term structural sort of money, which is not going to go away in a hurry. So I think our view is that FY27 will possibly again remain maybe slightly on the negative side for FPIs, but it won't be a big negative like FY25 or 26. And if some of the other markets falter at some point, AI trade goes out of fashion or, crude falls a bit more back to $70 level, then earnings for the other countries get hit a lot more, and then you might see, FPI flows into India. From a market cycle perspective, again, when we have looked at history last 15, 16 years, typically, the duration and the extent of correction, typically the duration, average length of bear market has been around 20 months, ranging from 11 months to 30 months like 30 months was the maximum longest bear market which we had in the history, and we are already into 18th month in this correction, from the highs we made in 2024 September. So from a duration of correction perspective, we are largely there, unless we go to the all-time, bear market length of 30 months, which means another 1 year we have, we don't have a big return. But that doesn't mean even in those 30 months, it wasn't that market was falling all the time, so I think in terms of extent of correction, we have had a fairly strong, as I said, 40% median correction for a lot of the stocks. So there is a possibility that we have another 6-12 months of time correction, and possibly, market remains in this zone of plus minus 5-10%. But then, we would be setting ourselves up for a rally in the subsequent period given the time correction. Typically you can work with 10-12% earning growth. So the moment market remains flat for 18 months means you are cheaper by 15-20% on P just by staying flat. Then the market is down 15% means you are cheaper by 30% compared to where you were. So, and I think the longer the time goes in terms of even market being sideways, market tends to become quite attractive. So we believe possibly we have seen the worst, and as I said, risk reward is now looking favorable for Indian equities, but don't expect a V-shaped sort of a recovery like we have seen in some of the recent past, because maybe flows will not come back in a hurry, and therefore if one is a patient investor, there are good enough bottom-up stock picking opportunities now available. So with that, I'll invite Unmesh to take you through some of the slides on flows, and then I'll come back and discuss the sector preference and model portfolio.
Thank you. Am I audible? Am I audible now? Yep. Okay. Well, thank you for the opportunity to speak. I welcome you all. I've got only 2 slides here, but I'm the only one who has changed his slides overnight because of what happened with Mr. Trump. So let's go to the next slide. I was also thinking about how, we should think about what I would like to add to this. Varun's covered the valuation in a lot of detail. I just want to highlight one point which he said, which we really need to get, absorb it, which is that whenever you look at FPIs, they are not investing in India either by thinking emotionally about what is happening in G20 summit or the movie Dhurandhar or anything of that sort, okay? There is no emotion to this. There is nothing like and this is after 23 years of having serviced FPIs, I can tell you that it all comes down to the one thing that Varun was saying, which is where is the relative valuation and what is the earnings growth. And this is why this chart on the right hand side is important. The one thing that you need to realize is that I was watching TV today just to see what the others are saying about this. And what I noticed was a lot of bears on the market are saying that India continues to remain at a premium to the other countries and hence it is still not time to buy. I completely disagree with that. The reason is because India has always in the last 30 years been at a premium to emerging markets. Because while earnings growth is one driver of valuation, there is also one very important driver of valuation, which is return on equity. If you compare that globally, what you will realize is that India has always been at a premium because Indian private sector well run and diversified. It's a nice country to invest in that context. Also, one credit to the regulator is that investor protection is very strong, as a result of which the premium is there. Now, in that context, what Varun was saying and what is on that chart over there is the fact that if you look at, this is a shorter term chart, okay, for just 10 years, but if you look at the 20-year history or 25-year history of Indian market over emerging markets, India peaked at a valuation multiple premium of 100% in 2023. At this point in time, the premium valuation of on PE basis of India versus the rest of the world is at 33%. This is actually at or slightly below the long-term average. As a result of which, we have anecdotally, even before the end of the war, because today, we've not had enough time to have that many conversations, but if you look at the history of the last 100 conversations that our team has done with investors, already we have started to get a lot of inquiries as to what they should be buying now in the market. So while that means that the work is starting, that still means that FPIs are not like waiting to do it tomorrow morning, but at the same point in time, if you look at the way in which FPI investors are thinking about this, we believe that actually the turning point in terms of the conversation and sentiment may have actually happened. And to a large extent, that is because of the valuation having come off. Now, what is it that is keeping the FPI investors away from the Indian market? To a large extent is basically what has happened to the dollar versus the rupee. And as a result of which there is a concern. And the second is that there is still a little bit of lack of clarity about how deep the earnings cut will get. Now, Varun's talked about how we will still get 10-12% earnings growth. We believe it is true, but at the same point in time, the moment people start to believe in that number, we believe that the valuation PEG basis, as in price equity, price earnings on a context of earnings growth will start to look very interesting. And that is when we start to think that people will come off. On balance, we believe that the fog of war has to go away for this to return. The only thing that I will say in this context, which is, because I could have been having this conversation yesterday or today, right? I could have been saying the same thing yesterday. The one thing that I will tell you today, which is a change over what happened exactly 24 hours back, is the fact that we now know that there is definitely a resolution for the war in sight. So anyone, when you look at, at the forecast of markets, nobody actually gives you a target. It's nice to do that, but actually what we do is that we give you a curve, as in what is the most realistic price target and what is the probability of that happening. There was a big tail risk that the market in the scenario of an ongoing war, let's say 2, 3, 6 months from now, the market valuations could go to 2 standard deviations below the mean. We believe that yesterday it has been proved that that case is not going to play out. Because there is back channel diplomacy, there is people are willing to talk to each other. And at the end of the day, this is not like 2008 or this is not like COVID, because this is a man-made disaster. And when there is a man-made disaster, man can reverse it. And we believe that we are on the path to that. So does that mean that everything is fine? The answer is no. But on balance, if you look at the weighted average probability, we believe that the market will now start to look at opportunity to invest. Now, how will that play out? Which is on the next slide. The first movers always will be the domestic. I think this has been a trend since 2016. Anecdotally, I can tell you that there is over 2 lakh crores of cash which is sitting with the mutual fund industry. This data is available to everyone. Having said that, in the context of AUM, this is 5.5%. What that effectively means is that there is always going to be 3-4% cash in the mutual funds, right? Because of various liquidity requirements, inflows, outflows. But at the same point in time, what that means is that there is some dry powder sitting. Now, as recently as Monday, I have been meeting the CIOs of some of the top mutual funds. I've been on the road since the day we ended the financial year, and I can tell you that one of the big things which is happening in the market today is, one is that the investors have started to look at valuations, start to get comfort, and what they are doing is that they are basically selling the lower quality stocks and going into higher quality, because that's where the valuations are more impressive. You can see it in some of the large caps especially. Also, the early trades have started to come through. We are seeing that on our desk as well, where all the sectors where the valuations came off with no real impact of the war, but which happened as a result of what I would say is in sympathy with the war, the buying has already started. You can see that in some of the stock prices, you can see it in the volumes. Structural themes, right? EMS, healthcare, power is a big one, all right? Staples, industrials, banks, these are the ones that we can actually see the move happening. And you know, boss was talking about the bounce back basket. I'm sure Devarsh is very excited about it, so he'll talk about it. But one big thing that is being talked about, which is actually taking a cue from this, is that there is nibbling which is happening which has started to happen on what we would say is the post-war scenario. There is no way anyone can predict when the war will end and when the clarity will come. But now that we have clarity that there is going to be some kind of resolution, this is the time to basically do a daily or a weekly or a monthly SIP where you actually go in and try to build those positions for stocks where you have a barbell kind of in front of you, where you have a very large weight to the high quality stocks, but you start adding risk to your portfolio. And which is why companies like IT, for example, right? Low valuations, anti-AI trade playing out, or energy, where I think the next cycle is going to completely get transformed, and we'll talk about that separately. And real estate and textiles, because what is interesting also is that 1 year from now, let's assume everything is normalized and gone back. And when we are sitting back and looking at this cycle, what will we notice is that the government is pushing very hard on manufacturing. A lot of small wins have already happened. And on top of that, the currency has depreciated. And suddenly you may find that a lot of manufacturing export stories start to look very good. And at that point in time, you look back and you feel that, you missed the trade. This is the time to start buying into that. Okay. So I'm going to ask Varun to come back on stage and talk about what sectors he likes and all that, but this is broadly the gist of what we are. Thanks, Varun.
Yeah. So, just to continue on. So I think, I just wanted to kind of, am I audible? Right. So I just wanted to give you a flavor of how we think, instead of, as I showed, while we are close to the trough valuations, we don't exactly know whether we'll bottom at, 16 PE or 17 PE, or we have already bottomed, as of 3 days back at 17.5, 18 PE. So instead of focusing on the market, we tend to focus more on stocks. We'll try to look for, growth at reasonable price. And our core philosophy is that in every market, there are sectors which tend to do well, unless it is a 2008 sort of a scenario when everything was down 50 to 60%. But even in that year, if you see FMCG was down only 20%. But this table just shows you that in all years, there are sectors which tend to do well and give you a very handsome return, even if the overall Nifty return, which is the, at the bottom, may not be attractive enough. You look at 2018, when entire mid and small cap was falling, Nifty return was 3%, but you had, IT sector giving 24%, which is a large sector. So I think this is something we try to work on. The idea is not always to kind of, get the market call right, but to get the sector and the stock call right, and, be in the right sectors and the right stocks which give you that alpha. So this is our, sector sort of outlook for FY27. the outlook which is neutral or positive tells you how we are positioned in our model portfolio in those sectors, and the arrow indicates the direction in which we are moving in those sectors in terms of whether we are adding to our positions in that sector or are we reducing our positions in the sector. Firstly, on BFSI, we are neutral, but I think you have to keep the context in mind. It's a sector which has a 30% plus kind of a weightage in the Nifty, and we were very positive and we are still reasonably positive. It's just that, in February when IT was selling off in a big way, we found that risk reward in IT had turned more attractive. So we did kind of go from overweight to sort of neutral in BFSI, and we went from underweight to neutral in IT. But as of now, with BFSI having corrected post that because of the geopolitical issues, now BFSI is also looking again, attractive on an absolute basis. So these two sectors now constitute more than 45, almost 45% of our model portfolio. So basically these two are the sectors where, possibly, we see the best risk reward, and, IT is a non-consensus call. I think people are overly bearish. Our house view is that AI will not kind of, AI will obviously make them tweak their business models, but we believe, the companies have enough levers and have the history to, they have shown in the past that they can adopt to different cycles, and in fact, we believe that AI led growth will pick up in FY27 second half and FY28 when more AI deal implementation will come through to these companies. And valuations after this round, we were running underweight on the sector for almost 3-4 years, and now we have done neutral, and if it falls a bit more, we would be very happy to go overweight. Consumer staples, we are still neutral, but again out there direction with the stocks falling again on crude concerns, and overall volume recovery is starting to come through even in consumer staples. Directionally we are turning a tad more positive, but again this is one sector where we have gone from underweight to neutral and not not overweight. Consumer discretionary is what we prefer in the consumer space compared to staples, and that has been a slight overweight call for us, and we are happy to kind of maintain that, but it's very stock specific. There are still pockets where valuations are extremely high, and we are choosing not to be in those pockets of consumer discretionary. But some of the parts of consumer discretionary have seen sharp sell off, and we have been nibbling into them. Things like paints, eating out, some of the apparel names. So I think these are where things have started to look more attractive on a risk reward basis. Industrials and infrastructure continues to be a positive call for us. We have been, this is more structural, we believe. We saw globally as well that this is a theme which is playing out because of the build out which is happening, or from the defense side, spending on defense, or on the AI data center side. So I think industrials and infrastructure will continue to be structural call, and we remain overweight in that space, and we have been overweight largely in the last 3 to 4 years in that space. Cement, we are still negative. We are like underweight in our model portfolio. We find valuations not super attractive, and the pricing is still missing in the sector, and there is still more focus on volume growth, and there is a bit of oversupply from a capacity perspective. So cement, we are still negative. Real estate is another contrarian positive call now after the correction. We are overweight and adding more names in this correction. Like IT, we believe people have the fears are overblown. Everybody is saying that IT is going to get finished in India, and therefore real estate demand will take a hit. We believe that not to be the case, and therefore real estate after this round of correction, valuations had gone to extremely high levels, and therefore we had largely sold most of the stocks barring one. But now with the valuations down 40-50% in the space, and we don't see that much of an impact on pre-sales, frankly. FY26 and even FY27 are interaction with developers is indicating that the numbers are still going to be reasonably good. So real estate could be is a one sector where we are adding. Automobiles, we were overweight. We are, still continuing with that given the growth has been quite strong. Obviously, there is some room for PE derating given the sharp, outperformance in FY26, but we are again being selective out there and, picking up some of the now global growth stories, as well. Names like, we have Bharat Forge and Motherson Sumi in our model portfolio in autos. So you can say that in a way domestic automobiles we are now slight underweight, and some of the global names in the automobile sector we are overweight. Chemicals, oil and gas and pharma, these three we are underweight, neutral to underweight, and not looking to add any of these three. For different reasons, oil and gas will get impacted in terms of earnings. This is the only sector where there will be a large negative sort of earnings drag in FY27. And if you look at chemicals again, because of higher oil prices, we believe the margins can get compressed and valuations are still not completely in the attractive zone at a sector level. Again, a lot of chemical stocks have corrected very sharply. So some of the chemical stocks are looking good to us, but at an aggregate level, we are still waiting for sort of better entry points. And pharma, we believe, has outperformed already and now not looking so attractive in the context of other sectors. So we believe it's time to add more of domestic cyclicals rather than trying to hide in pharma. And among the two export-oriented sectors, we now prefer IT over pharma, which was till we got neutral on IT, pharma used to be overweight, but now we are cut pharma to neutral and will look to go even underweight possibly. These are some of the key stocks in each of the sectors, from our model portfolio. So this just gives you a sense of the 20-30 stocks which are our top picks out of our coverage of 270 stocks. So autos, Bajaj Auto, M&M, Bharat Forge, Motherson, as I was saying, which were two sort of, not clearly Indian auto sort of names. BFSI, ICICI, Kotak is actually underweight for us. SBI, so ICICI, SBI, Axis, are the main overweights. In consumer staples, we own only two names: consumer discretionary 3, industrials infra 3, and so these are the main names. It's a combination of large and mid. We, in fact, throughout last year, despite being negative on mid and small caps, at an aggregate level, we were still able to find stocks, and we have been running mid and small caps at almost 30 to 40%. So as I said, instead of we were finding froth in some of the large caps as well, 12-18 months back, and therefore if you see at an index level, correction has been quite sharp even in Nifty. So it's very stock specific. Even today we are happy holding 35-40% in mid and small caps, and if attractive opportunities come, we would be looking to increase that even further. But we don't typically go by a targeted sort of allocation on large cap versus mid cap, but typically right now we are at 60-65% kind of a large cap, and rest mid and small caps. So I think which is mid and small caps with better earning growth tend to give you that alpha in the portfolio which is needed to outperform the indices. So yeah, I think with that I'll invite Dhiraj to come and speak on the retail behavior.
Thank you. So I'm going to cover three portions. One is about retail behavior. Second is about our preferred stocks, and sector preferences. So let me just start from the retail investors. Let's try to define a typical retail investors. Just like in this room, typical retail investors, 75% are male. Even here, not even 25% are female. But typical retail investor is 75% male, 25% female. And somewhere we have Nitesh here. Yesterday I was talking to him, doing a podcast. Nitesh is our marketing person who looks after our podcast and social media. He is representative of India's retail investors. He is about 33 years of age. That's what is the typical retail investor's median age is. They have invest about 10,000 to 10 lakh rupees a month into Indian markets. The typical retail investors, 90% of them, 37% invest less than 10,000 rupees, 32% of retail investors invest between 10 lakh to 1 lakh rupees a month, and around 21% invest about 10 lakh. So between 10,000 and 10 lakh a month, 90% of the investors invest into Indian market. Good return. So if you are investors are sitting on cash, certain portion of that cash can be deployed in this capital, in this basket, and that's what we have told this basket, named it as a bounce back market. I will not go into all the names are there, but just to give you an idea what kind of stocks we have chosen from oil marketing company and aviation. These are the ones which have been affected severely. Then on the construction theme, see, hydrocarbon projects have been delayed because of the war. Many projects have been destructed, so all those things will need rebuilding. And I think companies like L&T and others who are playing into that theme will be one of the beneficiaries of bounce back. So same way we have chosen about 10 stocks of different 10 sectors, given a 10% weight, and we hope that this basket is likely to be one of the outperformers when the war and other geopolitical uncertainties come down. So this basket is available on our website, and now investors can also start investing into this. Thank you. That's what I wanted to cover. Now I'll hand it back over to Mandat.
Thank you to all the speakers for such insights. I'm sure these will be very crucial for everybody to navigate the financial markets this year. I would now like to go to the portion where, we'll have the closing address by Dhiraj Relli, and then followed by that, we'll have the question and answers. So,
Once again, thank you very much for your time, and I'm sure you got some insights and you are better informed about the way forward for the markets. My takeaway from last one and a half hour are clearly that foreign portfolio investors are not coming back to the India in a hurry, particularly because they, unlike Indian liquidity that is married to India, which means that the domestic flows that we are getting will continue because that's the liquidity that is married to Indian markets, whereas FPIs have opportunities, particularly on the AI side in different markets, US, Korea, Taiwan, and many more. That something is not available unless until we see a clear unwinding of AI trade happening and they see more opportunity in India. That's when they'll start to invest in India more. But having said that, we may not get the relentless selling from the FPIs to continue in the FY27. So which means that we'll have a lesser pressure coming in from the foreign portfolio investors, whereas we believe that the domestic flows will continue to be robust and strong. We may see some corrections, some dip in the SIPs in the next month, this month and next month, or maybe for a few more months. Net SIPs may degrow. But having said that, the Indian investors will come back to the markets with the vengeance, and we will see more number of investors investing in the Indian markets through the SIP route and even in through the primary market route, or even in the lump sum investments also. So to that extent, domestic flows will remain strong, and primary activity will also remain strong in Indian market. Secondary market side, we believe that the risk reward is favorable here, and which clearly means that we will have an earning growth of 10 to 12% minimum, and that's where we see Indian capital markets to do well, secondary market to do well, and more so because the risk reward is favorable. It is easier for us to do a bottom-up stock picking versus what we were finding difficult in the 18 months ago and in this entire period, Now we see a better opportunity for us to help our investors to invest. We have like Varun mentioned, that we can now pick out of 270 stocks, close to 100 stocks, where we see opportunity. Earlier we were finding it only about 10% of the same as good opportunity. So having said that, we believe that FY27 will be a good year. Of course, we can't, give you a decisive outlook on the war side. That's something remains to be a one variable which will bring in more and more volatility in the market. And if we see a decisive end of the war, then we see a significant upside from here onwards. And we are looking forward for a good FY27 for Indian markets. With that, we'll take your questions, and I'll invite my colleagues to come on this dais. We set that up for you. Yeah, okay, no problem.
Yeah, I request all the speakers to please join us on stage. To the media, please state your name and the outlet that you're asking the questions from so that it's easier to address your queries. Thank you so much. Yeah, can we have the first question, please?
I am Nandkishore Bharati from Navbharat. मेरा प्रश्न ये है कि now RBI governor says today कि all economic factors are very strong in the economy in India. In this scenario, if the war is stopped in next 2 weeks, what will be the future outlook about the Sensex, Nifty, gold and silver and rupees by your estimate? Please.
Yeah. So, as we said, in terms of index, with earning growth of 10 to 12%, from these levels, if war ends today, and there is no sort of further escalation and crude doesn't go above that $100 levels, then we can look at, at least 12 to 15% kind of return in Nifty from, current levels over next 12 months. So that's on Nifty. On gold and silver, as we said, they are looking a bit stretched, and as I showed in one of my charts, equities are looking more attractive than gold at this moment, and gold is looking slightly better than silver. So if that's the context, then gold and silver, we don't expect a double-digit returns in this financial year the way we expect in equities. So possibly the asset class to kind of put incremental money in is equities now.
Yeah, hi. This is Abhinav from Mint. I have a question regarding the earnings. So Q4 earnings are, on its way. So the street estimates are around 6% for Nifty 50. What is your estimate for Q4? And also we saw that, in Q3, the margin tailwinds were sort of fading compared to the revenue growth was there. But what about this particular quarter, especially we are seeing the metal prices are up, and last quarter, obviously, there was some labor laws that did eat into margins. But now, what is your forecast for margins this particular quarter?
So in Q4, our forecast for our coverage universe is around 10 to 11% earning growth, but that includes some mid and small cap. So if I were to kind of look at Nifty, then possibly it would be 7 to 8%. But I think in Nifty right now to call earnings, especially for OMCs, is very difficult for this quarter because how much inventory they were sitting on. So their numbers will be quite volatile, and that's a big component of the oil and gas earnings and metal. These two are fairly big components. So while one will be positively impacted, metal sector will have a strong earnings this quarter. Oil and gas might have a weakish earnings, and therefore on a blended basis we expect around possibly 7-8% on Nifty and 10-11% for our coverage universe.
Also, do you expect private banks to do better than public sector banks this quarter going forward, or last quarter we saw public sector banks outperforming their private peers?
So public sector banks have been doing tad better in the sense, one, their growth rates have really picked up in the last couple of years compared to private sector banks. They have been able to grow better both on the advances side and even on the deposit side. Credit cost obviously has been all-time low in the banking system, and so PSU banks who had a bigger problem on the credit cost side benefited more, and even the recoveries were quite strong. And thirdly, they also benefited on the bond yield bit, the treasury gains. I think a part of that will get reversed now with bond yields having spiked in Q4. So I think incrementally when we are looking at, so for last 12 months PSU banks were looking more attractive than private sector banks. I think now the trade looks far more balanced. One, because private sector banks have corrected in valuations and public sector banks have re-rated in valuations. So valuation gap has disappeared. I think now both are trading at more or less fair valuations. PSU banks at 0.8, 0.9 time price to book, and private sector banks in the 1.5-2% sort of price to book range. So now, frankly, we don't have a big preference for PSUs as a pack versus private, which we had for almost 12 months. Now it's very stock specific. We like Axis a lot or ICICI a lot from the private sector space, but we still continue to own SBI and say Bank of Maharashtra in our model portfolio. So we have 2 PSUs and 2 private sector banks among the large positions. So it's more even now.
Thank you. That's it.
I'm Sundar from Business Standard. Few questions. One, do you have any target for Nifty for the FY27? And secondly, you said that the earnings growth will be 10 to 12%. Is it for the Nifty earnings growth or your coverage?
So that is for the coverage universe. So what was 18% pre-war, we said there would be around 500 bips, which is 5% shave off, which means that for our coverage universe we'll possibly get around 11-12% kind of earning growth.
How many stocks are there in your coverage? 270.
270, and Nifty would be slightly lower. Nifty will most likely be in around 9% kind of a range, 9-10%. Mid and small caps will have a better earning growth than Nifty for FY27.
So you expect Nifty to go up by 9-10% from the current levels?
Yeah, we said there is room for some PE re-rating and at least this 9 to 10%. So Nifty can go up in low teens, can go up by 12 to 13% in FY27.
12 to 13% from the current levels. And you have any number?
Today 3% has come, so
no, but
maybe
do you
only
have any
10%
number
is left.
for Nifty?
No, so we don't come out with a absolute number. As I said, the idea is more to get the stocks and sector right and outperform the Nifty by 400-500 bips through our model portfolio, which we have been able to do over last 5-6 years.
And how long do you expect the crude to be elevated? Because there have been some reports that it will be at $100 levels because of all the attacks on the energy infrastructure. So
I think
do you have any view on that?
If war were to stop today, then I think another 3-4 months it would take for supplies to resume. But then if war were to end today, then possibly it will average at $100 like for India, it would possibly remain at $100 for the first quarter, definitely, and maybe till first half of second quarter, like first half of the second quarter, and then second half it can fall back to $80-90. So blended would be sub 100, which is a very comfortable position if if that were to happen from a macro or a fiscal perspective.
हाय माय नेम इज़ कंचन औटियाल आई एम फ्रॉम CNBC आवाज़. क्वेश्चन मेरा थोड़ा सा लंबा है लेकिन समझना बहुत ज़रूरी है इन्वेस्टर पर्सपेक्टिव से. पिछले 1-2 साल की अगर बात करी जाए तो मार्केट में हमने काफ़ी बड़ा सीसॉ देखा और वो सीसॉ डाउन साइड में ज़्यादा रहा है एज़ कम्पेयर टू हमें हायर साइड में, चाहे वो ग्लोबल ट्रेड की बात हो, चाहे वो बात इस टाइम पे हम करें जिस तरीके की जियोपॉलिटिकल टेंशन है. इससे हमने देखा है कि FPI ने केवल मार्च में ही अप्रॉक्सीमेटली 1.17 लाख करोड़ का आउटफ्लो करा है. इनफैक्ट आज की अगर हम गवर्नर की स्पीच भी देखें तो वो भी इन्फ्लेशन को लेके काफ़ी ज़्यादा कंसर्न है और Q1, Q2 को लेके उन्होंने कहीं ना कहीं कंसर्न्स जताए हैं. इन्वेस्टर्स क्या करें? आज तो मार्केट में रैली आ गई तो अच्छा लग रहा है कि शायद से वापस से मार्केट में एक रिवाइवल आएगा, लेकिन ये रैली कॉन्टिन्यूसली हमें होती हुई दिखाई देगी. क्या डिप्स पे बाइंग अभी सजेस्टेड है या फिर अभी एक कॉशियस अप्रोच इम्पॉर्टेंट है?
It's a really long question. I'll try and attempt to give you an answer. But before that, I think Sundar was looking at what number. I'll be happy to say that we are just 10-12% away from all-time high levels of 26,277, if I am right. Really, if my memory supports me, we should get that number in this financial year. If we get, whether we get it in second quarter, third quarter, fourth quarter, I don't know, but I hope that in somewhere closer to Diwali, we should get that number. So that's one piece. आप सही कह रहे हैं कंचन, क्या कहते हैं कि पिछले 18 से 20 महीने अगर हम देखते हैं तो एक डाउन साइकिल थी कैपिटल मार्केट में, पूरा मार्केट्स में, और इस पीरियड में लोगों ने देखा क्या कहते हैं कि उनके रिटर्न्स, चाहे वो रिटर्न्स एब्सोल्यूट वैल्यू हो या SIPs में हो, दोनों में उनके रिटर्न्स नहीं आए हैं और थोड़ा सा कंसर्न रिटेल इन्वेस्टर्स को और इवन इन्फॉर्म्ड इन्वेस्टर्स को भी रहा है इस पीरियड में. आपका सवाल ये था कि इस क्या उनको अभी इन्वेस्ट करना चाहिए इस सिनेरियो में या नहीं. हमने जैसे पिछले 1-1.5 घंटे में बात की कि इस समय रिस्क रिवॉर्ड इज़ फेवरेबल और वैल्यूएशंस आर रीजनेबल. हमारे पास अपॉर्चुनिटी है कुछ स्टॉक्स को बॉटम अप पिकअप करने की, और वहाँ पर हमें लगता है क्या कहते हैं कि अर्निंग ग्रोथ और रीजनेबल वैल्यूएशन, culmination or combination of these two factors will throw a big opportunity. Having said that, it's never a great idea to catch a falling knife. So I will not say that key investors should see that the war is ending or war has ended and start jumping into the market immediately. Staggered investing, SIPs flows can continue, and maybe if they don't have an incremental money also, they can move from a sub-optimal stocks to a better value stocks. तो अगर पोर्टफोलियो ऑप्टिमाइज करने के लिए अगर अपॉर्चुनिटी ढूंढेंगे तो उनको बहुत सारी अपॉर्चुनिटीज़ मिलेंगी. दे कैन, बिकॉज टाइम करेक्शन और प्राइस करेक्शन की वजह से वैल्यूज, देयर इज़ ए रीजनेबल वैल्यू इन अ हाई क्वालिटी काउंटर्स. वो अगर उन स्टॉक्स में इन्वेस्ट करेंगे तो दे विल बी बेटर ऑफ इन टर्म्स ऑफ प्लेइंग आउट इन दिस डाउन टर्न साइकिल इन द मार्केट. Next year looks better to us than what we have seen in the last 18 months.
I think just on the FPI selling जो आपने बोला है उस पर एक बात था कि मार्च का नंबर बहुत बड़ा लगता है, 1,30,000 करोड़,
1.17 lakh crore.
yeah, around, which is $15 billion. But अगर आप अगेन ग्लोबल कॉन्टेक्स्ट में देखेंगे तो मार्च में एमर्जिंग मार्केट से FPI ने $56 बिलियन निकाला है अक्रॉस मार्केट्स. तो इंडिया में $12 बिलियन निकला है. इंडिया का 15% वेट है रफली. तो विच मीन्स कि मतलब इट इज़ मोर और लेस इन लाइन विद व्हाट दे हैव सोल्ड इन अदर मार्केट्स लाइक कोरिया, ताइवान में, कोरिया में दे हैव पुल्ड आउट $26 बिलियन इन मार्च. सो व्हाट हैपेंस इज डिस्पाइट से इट्स सो व्हाट आई एम ट्राइंग टू से इज कि समटाइम्स these reactions by FIIs, especially on these geopolitical events, when money goes back to the home market, risk of trade is there, तो relentless selling होता है. और जो जिस भी मार्केट में है सब में होता है. तो डजेंट मीन कि इंडिया ज़्यादा ख़राब है इसलिए इंडिया में हो. हमें लगता है कि हमारी मार्केट में बहुत ज़्यादा सेलिंग हो रहा है, इंडिया मार्केट ही ख़राब है क्या. तो दिस इज जस्ट टू गिव यू द कॉन्टेक्स्ट दैट सेलिंग हैपेंड इन मार्च इन एवरी मार्केट. नाउ इट्स अ जो लास्ट 2-3 साल से सेलिंग हो रहा है या बाइंग नहीं हो रहा है, दैट इज फॉर दोज रीजंस आई शोड यू कि अदर मार्केट्स वर बेटर. बट मार्च एक ऐसा इवेंट था ग्लोबल शॉक का, या जिस टाइम पे कोविड भी हुआ, कि उस टाइम पे एक बार ही सारी मार्केट से पैसा निकलता है. तो वो एक महीने का नंबर से वी शुड नॉट गेट ओवरली वरिड. वो वापस भी आएंगे तो एक महीने के अंदर ही वो 70-80 हज़ार करोड़ भी खरीद लेते हैं. बिकॉज FIIs डोंट गेट सो फिक्सेटेड ऑन 1 or 2% काइंड ऑफ मूव्स इन द ओवरऑल स्कीम ऑफ थिंग्स. सो उनको निकलना है तो निकलेंगे वो एक महीने में, जब आना है तो एक महीने में आ भी जाएंगे.
थैंक यू सो मच.
नहीं, आई जस्ट वांट टू ऐड वन थिंग. सो ये जो डेली NAV वाला जो प्रोडक्ट है वो काफ़ी हद तक इज़ एन इंडियन फिनोमिनन. तो इसीलिए हमारा भी ऑब्जर्वेशन ये रहा है पिछले ऑलमोस्ट 22-23 साल में कि अगर किसी का कन्विक्शन है FPI का कि वो इंडिया खरीदना है या बेचना है तो 1 or 2% मूव से फ़र्क नहीं पड़ता है. वो लोग विजिबिलिटी पे ज़्यादा फोकस करते हैं, वेदर दैट इज़ हैपनिंग और नॉट. नाउ कमिंग टू योर पॉइंट ऑन जियो पॉलिटिक्स, व्हाट इज़ हैपेंड इज़ दैट जियो पॉलिटिकली अगर आप इंडिया वॉर विद पाकिस्तान देखेंगे या अगर आप इस समय देखेंगे तो इसमें एक बड़ा डिफरेंस है कि वो वाला जो स्कर्मिश था उसके वजह से ग्लोबली इमर्जिंग मार्केट पे नेगेटिविटी नहीं क्रिएट हुई थी, वो सिर्फ इस वाले पे क्रिएट हुआ है. सो व्हाट हैपेंस इज दैट जब व्हेन FPIs हैव बीन सेलिंग, एक तो वैल्यूएशन वाला कंसर्न था जो अब काफ़ी हद तक रिसीड हो रहा है. दूसरा ये ग्लोबल जियोपॉलिटिक्स वाला पॉइंट है विच ही वाज टॉकिंग अबाउट. एंड देन थर्ड इज द फर्स्ट पॉइंट दैट यू मेड विच इज़ अबाउट व्हाट वाज द RBI गवर्नर सेइंग टुडे. मैं भी स्पीच सुन रहा था, आप में से कई लोग तो होंगे भी उनके प्रेस कॉन्फ्रेंस में. मैंने क्या नोटिस किया कि वो स्टार्ट कंसर्न से किया था और फाइनली एट द एंड ऑफ द डे देखिए क्या होता है कि ये प्रेस कॉन्फ्रेंस सारे लोग देख रहे होते हैं. तो कहीं भी ग्लोबली आप फेड का देखें या मैस का देखें या किसी का भी अगर प्रेस कॉन्फ्रेंस होगा तो दे आर नॉट गोइंग टू कम आउट एंड गिव यू अ बैलेंस पिक्चर. एंड वहाँ पे देर इज़ डेफिनेटली कंसर्न ऑन इन्फ्लेशन, देर इज़ डेफिनेटली गोइंग टू बी सम कंसर्न ऑन अर्निंग्स एज ही वॉज पॉइंटिंग आउट, बिकॉज कुछ आपने हाई कॉस्ट को लॉक भी किया हुआ है. तो ये क्वार्टर जो आएगा इसके बाद जो आउटलुक होगा अगले क्वार्टर में उसमें नंबर्स कटेंगे. लेकिन द पॉइंट दैट वी आर ऑल मेकिंग इज़ दैट ऐसा लगता है कि द वर्स्ट पॉइंट ऑन दैट इज काइंड ऑफ ओवर एंड गेटिंग मोर एंड मोर क्लियर कि कितने डाउनग्रेड्स आएंगे. और वैल्यूएशन जो है वो इस पॉइंट पे आ गया है कि जहाँ से बहुत ज़्यादा डाउनसाइड नहीं दिखता है. तो अगर इसको आप कंबाइन करेंगे तो क्या ये मार्केट में ये सबसे बड़ा कंसर्न ये है कि लोगों को आदत हो गई है वी शेप रिकवरी की मार्केट में, क्योंकि वो 2021 में भी यही हुआ, 2008 में भी इंटरेस्टिंगली यही हुआ था, 2018 वाले में भी यही हुआ था. हमें ऐसा लगता है कि शायद वो वी शेप रिकवरी नहीं आएगी, इसीलिए एक स्टैगर्ड इन्वेस्टमेंट स्ट्रैटेजी होगी. तो ये बहुत अच्छा एंट्री पॉइंट है. 18 महीने बाद जब आप देखेंगे तो आपको लगेगा कि अच्छा एंट्री पॉइंट था, लेकिन हो सकता है कि उसमें बीच में 6 महीने आपको लगे ये क्या कर दिया मैंने. सो ब्रॉडली दिस इज व्हाट वी आर ट्राइंग टू से.
थैंक यू एवरीवन.
Hi, my name is Saurav Mukherjee and I represent ANI News. I was at the RBI Monetary Policy Committee today meeting, and means like as you mentioned, means like the governor sir means like started with the concern related with the geopolitical issues and means like the economical impact on India and the Southeast Asia and every global trade. So means like my question is we'll start from the point that you have mentioned. It's like in FY27 the earnings will be on the negative side for the first H1, and there will be we will have a possibly we have seen the worst, but it won't be a V-shaped economical growth as mentioned means like in the big review of yours. So my question is to you is crude INR have too impacted in in Q4 FY25-26. Now RBI has predicted that the GDP to be at around 6.9% for the FY27. How do you see RBI's policy announcements taking shape in the current fiscal? And this is a very genuine question to all of you. did the RBI's policy announcement stood up to the expectations that you are looking at, citing the lack of, there has been a lack of clarity on the FPI and FDI inflows, especially in March and Q4 of FY 2025-2026?
So far as RBI policy is concerned, I think RBI has been very constructive, and they have been, taking decision back on the numbers only. They've clearly have understood and evaluated the impact of geopolitical situation. They have a better handle on the same. They are very well informed on what's happening, what could be the possible negative outcome or positive outcome of the geopolitical events. I think they have done threadbare calculations on the same. With that basis only, they have tapered the GDP growth to 6.9%, which is a very reasonable tapering. We don't see any further downside. Maybe 10-20 basis point, like our estimate could be probably 6.7 to 6.8%, but we are conservative in our assessment here. And we believe that they have been constructive in terms of reducing the rates. I don't see any knee-jerk reaction coming in from the Reserve Bank of India on increasing the interest rates in a hurry. Of course, it will be backed by the data only. So to that extent, they have given now, first time they've given the full 1 year outlook on the inflation also, and broken it down to the quarterly also, and it's peaking in the third quarter and then tapering off in the fourth quarter also. To that extent, I think it's a welcome move from Reserve Bank of India to give a more detailed quarterly assessment of the inflation, and we believe that its inflation is also within the range. 4% plus minus 2% is their comfort zone. To that extent, 4.7% average inflation for FY 27 is well within their range. So no knee-jerk reaction. We've already seen 10-year yield moving up by 40-50 basis point to almost 7%. So to that extent, I think we are already seeing whatever the response or whatever be the negative outcome of the inflation and interest rates factored into the 10-year yield. In fact, it's just topped. According to our belief that it has already topped. So we don't see a significant impact on increasing yield, whether it's in India or even in US.
There's a second question. This is also like to Devash Vakil. Since we have already discussed in the previous meeting also, like we have discussed about the US economy, which is K-shaped, right? And India, like looking at a V-shaped economy. This is how we are expecting that India's economy to revive post this war is over, if this war is over within 2 and 3 months, and the impact of it will sustain for next 2-3 months. Now the question arises that how is India going to tackle, especially in the indices recovery, and especially in the sectors related like BFSI, commodities, and consumer market and all. How do you see Indian economy to revive, especially in the markets, especially in the related of commodities and likewise?
Right. So, talking about this geopolitical crisis, how does it affect Indian economy? It affects through the crude oil prices, right? And higher crude oil prices have impact across sectors. Now, if we were to take only the few days have passed in this financial year, if you look at the RBI's policy today also in MPC, what they've assumed is that for the next 1 year, crude oil will average around $85 a barrel. So the current elevated prices are likely to come down as and when war comes down. Okay, so we don't think that will have an impact on a growth, and that's why only few basis points have been shipped down on the GDP growth. So once the crude oil prices are back, again all these hindrance which you mentioned will be tackled. Other macroeconomic parameters of Indian economy are quite strong. As we showed in our presentation, the capital expenditure is high. The banks have good balance sheet, and we are seeing good growth on the credit side. That means that the economy will be able to sustain this whatever last few days of shock, and will be able to grow. Inflation is under control. barring one point, which is monsoon, which we saw that there could be below normal monsoon. Other than that, I don't think this event will have a lasting impact on our Indian economy, and Indian corporates will be able to grow.
Varun, this is a question to you, especially related with the INR. The Indian currency has depreciated to a certain low of around 96 and 97 relatively in March last week. Especially when you look at the week, that means like that's proceeding, and means like when you listen to the reports where US saying that we will US and Iran saying that we will stall the war for 2 to 3 weeks. Now, what's your take on how the Indian currency may perform in the coming 2 to 3 months, and how the stock market may perform post this 2-3 months that you are looking at? How exactly, what's your opinion on, what's your outlook on the entire thing?
See, currency, as we said, we believe we are, at the fag end of that period when, INR depreciated sharply against, most of the other currencies, and we are, I think, already seeing some stability out there. It touched 94, 95. RBI also intervened and, took a couple of steps to kind of, stem the downside. And now it seems to be in that 92, 93 zone. If we look at drivers of currency, and I had put that chart, if you look at the 3-4 main drivers, one, FDI flows, like net FDI flows, given primary markets were very strong, had come to zero, last year. Now, with markets not as strong, primary market activity should be lower this year, which means that net FDI flows will look better because gross FDI is fairly stable. FII flows, as again we said, FY27 will be better than FY26. We'll at least not see a big outflow even if we don't see a big inflow. So these two will incrementally get better, the two factors. Third, balance of trade, that will worsen compared to FY26, especially in the first half, given the crude thing. So there will be an offset impact. So net on these three factors, we don't see that incrementally things will keep getting worse at the same. Last year all three were negative. Now, like two would be incrementally better and one would possibly move on the other direction, and therefore a sharp appreciation is ruled out, I think, for the time being. But we believe rupee will remain stable in this 92, 93 to $95 to $2 kind of a range. Plus other thing is, I think if war subsides, then dollar index can again weaken a little bit, because as I said, there was a flight to safety, so dollar was outperforming against most currencies last month. Now, I think some of the other currencies might start to appreciate against dollar to some extent, including India.
Hello everyone, I have a question. Suresh from Informist Media. Just on the point of rupee appreciation or depreciation, do you see rupee depreciating as a factor that is holding off FPIs, because that will be considered when foreign investors. So how do you see that factor playing, out, considering, in terms of investing in the Indian market, rupee depreciation? And so second, how is India placed in terms of, how is the Indian market placed in terms of, with compared to emerging markets, how is that going to influence the Indian market movement in FY27?
So, definitely currency becomes a big sort of a variable when a FPI is looking to invest in a country, because he is, concerned with, returns in his own currency or, dollar denominated returns. And therefore, that was part of the reason when the drivers of Indian currency were looking weak in the last 12-18 months, that FPI stayed away and in fact pulled out money. And we should always look at corrections in equity markets in dollar terms, or similarly the gains in dollar terms, because that's how one of the large investor, which is FPI, is looking at. So while markets are down whatever 15% in rupee terms, in dollar terms they are down more than 20%. So which makes it even more attractive for an FPI when he is looking to invest fresh money, because whatever depreciation has happened has happened. And a modest depreciation of 3 to 4%, is something which every FPI works with when he is investing in India, because that's the normal depreciation, and that is okay because your earning growth are also much higher than most of the other developed markets. But what they are always worried about is a very sharp depreciation period, the kind of period we had last financial year. And typically you will see that, I had showed it in the chart that it tends to happen in spurts. So there was a period in 2012-13 when this kind of a depreciation happened, and then for 3-4 years rupee was relatively stable. And similarly, we believe after this episode, of dollar rupee going from 75-80 to 93-95 levels in last 18-24 months, now we'll possibly are entering a period where rupee behaves a lot better than what it has in the last 18 to 24 months, which will also give confidence to FPIs to return. Because till the time they see a very sharp depreciation, rupee falling every day, they would not come.
Thank you. That's all the time that we have today for the question and answer. In case of any further queries, please reach out to our corporate communications team. They will help you address or connect with any of the speakers if needed. This brings us to the conclusion of the big review today. Thank you everyone on behalf of HDFC Securities for joining us. Thank you to the speakers for an insightful session. We are also happy to invite all of you to the second edition of Powerful Voices in Finance Awards today evening, starting at 6 p.m. today in this venue itself. The registrations will start at 5:30 p.m. We will hear from some of the truly fantastic speakers this evening, such as Ms. Shri Sundararaman Murthy, Prashant Jain, Nitin Chugh, Nimesh Shah, Vikas Khemani, Krishna Sangvi, Ms. Vibha Padalkar, and our very own Mr. Dhiraj Relli. Join us for an evening incredible conversation as we celebrate the organizations and individuals leading the charge of financial literacy across India, hosted by none other than the stand-up comedian Anirban Das Gupta. We hope to see you there. Thank you again.